to the Chris and Melissa Lombardo podcast. From real estate to lending to landscaping to construction and everything in between, this is an exciting podcast that digs into everything home related, including products used in the industry. We have special guests every week who are professionals in the home industry, giving our listeners exciting insider information. Let's sit back, relax, and dig in. This is the Chris and Melissa Lombardo podcast.
Thank you for joining us today. We have the amazing Grover Greer here with us. He is with Fairway Independent Mortgage Company, and he is our preferred lender, actually. We use him for our personal business. We use him and recommend him very highly to all of our clients. And Grover, thank you so much for joining us today. How are you?
I'm great. Thanks for having me. Very excited to be here.
No problem. So we wanted to bring you on, Grover. Do you want to tell us a little bit at first about how you got into lending and maybe, why it would be important to use someone like you in this market, but just in general in the home buying process?
Sure. So I've been a lender since 2005. I kind of backed into the industry. I knew a friend that said, "Hey, I think you'd be good at this." I just had my son and just thought I'd give it a shot. I was bartending at the time and looking for something outside. Thought about getting my real estate license and kind of fell into it. For the first few years, I called like online leads. So I was the online lender. Had great success with that, but then decided that it'd be good to start getting great relationships and partner with people that we could grow together. The second part of your question kind of being like, why is it important to use a lender like me? Well, I've been on both sides of the fence, and whether you're going into a bank or a credit union, or you're getting online and just scavenging rates, it's very dangerous because typically those people are paid, salaries, which is not good because they have no vested interest on if you close on time, if your money's protected or anything like that. Whereas if you come to someone like me, we have professional teams and we're built on referral only. So we care on closing on time, doing a great job, making sure our referral partners are happy, and of course, making sure the client's happy and that the client's protected. So we close on time, we close accurately, we communicate. We don't work quote unquote bankers hours. You can get a hold of us nights and weekends, which is when most of the transactions are going down. So it's important to have a professional that truly cares about what's going on from bell to bell, whether it's a real estate agent or a lender.
And I want to back up on that and just contest to what Grover just said as far as getting a hold of your lender and how important that is, not working bankers hours. We've worked with both credit unions and then also Grover. And I've called Grover 10 p.m. on a Friday night and was able to get a hold of him. He picked up and answered his phone on a Friday night at 10 p.m. and early Saturday mornings. I know I could always count on Grover to answer the phone. On the other hand, working with a credit union, they are working bankers hours. When we need to get an offer in late on a Sunday night and we need to get a hold of the lender to get a pre-approval letter in, I'm able to get a hold of Grover late on a Sunday night to get that in, where I'm not going to be able to get a hold of a lender from a credit union. So
absolutely.
Yeah, I mean, the old saying is time kills all deals, right? And I think that's very, very true in real estate. It seems like anytime you drag your feet and you're not quick and you're not all unified and ready to go, someone's going to come in over the top. You know what I mean? You never know what's going to happen. So speed can be very critical to getting us the deal that we want and getting our clients the home that they desire.
Absolutely. And not only that too, Grover, as far as developing that relationship too, we really do appreciate what you do for the clients that we work with mutually. I do know we've tried to connect with some other lenders that buyers have brought to us, and it just seems like they're a number to them. And so they don't really know and understand their personal situation, which can be very important too in winning that deal for them too. So thank you for that.
So let's talk rates a little bit, Grover. Where are we seeing rates at today right now?
Good question. I mean, rates are in the low sixes week over week. I mean, it's a bumpy ride, but week over week, we've seen 3 weeks of gradual improvement for the first time in a long time. So they're sitting around the low sixes, 6 1/8 to 6 1/4. You can do a permanent buy down to get into the fives. So we're seeing improvement. The saying at the beginning of the year by all experts is they're going to come down, but it'll be a rocky road. So day to day, It just depends. Today was a little bit of a rougher day, but that was expected because the Fed's going to speak here soon. But after the Fed speaks, we usually see improvement because most of what he's going to say is already baked into the market. So we're seeing him slowly start to trickle down, which is in turn increasing our buyer demand, is what I'm seeing so far to start the year.
So when a professional like yourself says you could do a permanent buy down on the rate, someone coming in to buy a property, how much money do you need to do an average buy down?
The average rule of thumb, and it does depend on markets, the average rule of thumb is that 1% of your loan amount will get you 0.25% off your rate. And then a half percent of your loan amount will get you 0.125% off your rate. When you see rates go up the way they have over the last 7 to 10 months, you do see bigger opportunities in those permanent buy downs. The thought on the bank on the back end is that if you're paying that much money, you're apt to stay in the loan longer, and they plan on holding these loans on their books for 3 to 5 years. That's where they're hedging and thinking they're going to make their money. So they have offered a little bit bigger buy downs as the rates went up, because their fear, of course, is as these come down, everyone's going to be refinancing out of them quickly. They're thinking if you do a bigger buy down, you can get a little bit more bang for your buck and hopefully hold you in that loan for a little bit longer.
So right now, and we talk to buyers all the time, Grover, and their concern right now, obviously, are the rates and how expensive it is to get into a home right now. And so in their mind, they might be thinking, gosh, so to make it more affordable, I have to put more money down to buy down. What strategy can we use as agents, but then also as lenders, to help or to have sellers help us with a buy down in this market?
Yeah, so the most common one, affordability was hurt, right? We saw record levels of the cost of housing in the Denver metro area go up, and then we go to the higher rates. It really did hit our affordability quite a bit. So at the time, you got to adapt, and kind of what you touched on, the permanent buy down, I don't think is the way to go, because you are going to refinance out of this whether you buy down or not. Right. What I'm seeing and what I think the hottest and best way to do is if you have a seller where their home is sitting a little bit and you have an opportunity to negotiate as a buyer, and you're teamed with a great set of realtors like you guys and a great lender, you can negotiate what's called a temporary buy down. I think it's a super cool product. And we're seeing probably around 70, 80, maybe even 85% of our deals go under with this product of some kind. And you can do a 1-year temporary buy down, a 2 1-year temporary buy down, or a 3-2-1 temporary buy down. And what you're doing is you're asking the seller to put money, we call it a seller subsidy, and we call it the rate rescue. We're asking them to put money into a bucket, an escrow account, and they're going to temporarily lower your rate. So say your start rate was 6 1/4, and you do a 2-1 buy down. For the first year, you would pay 4 1/4, and that escrow account would pay the other 2% of that 30-year fixed mortgage.
So the seller is actually buying down the rate for the buyer. The buyer is coming with extra cash.
Temporarily, yeah. So they're making up the difference in payment. So we're seeing that's where you're getting the most bang for your buck. I see on average $500 to $800 a month, depending on your loan size, that you're saving for that first year. And the biggest thing that I think that I've been telling people is Fannie Mae predicts by the time we hit 2024, rates are going to be in the mid to high 4s. So what we would do is we would temporarily buy you down into the 4s. Then the beginning of next year, we'd refinance you permanently in the 4s, and you'd never ever touch those 6% rates. You'd never see them if Fannie Mae's prediction is correct, which most think it will be. That's what everything's showing. That's the way everything's trending.
Now, you mentioned that money is held in escrow. So if the buyer then does refinance prior to the end of the temporary buy down, can you tell us what happens to that money that's been held in escrow for them?
I'm super glad you asked, because I think it's the coolest part of the entire thing. If you do a permanent buy down, like we talked about before, that money's gone. It goes to the bank and you never get it back. The coolest part of the temporary buy down is you have that escrow account, and as a buyer, that is your money. So if you pay off your loan, if you refinance, if you do anything, it goes towards your payoff for your mortgage. So after your 6th payment, if we're talking about doing a permanent refinance, you should have a huge chunk of money in there that's going to offset the cost of refinancing and almost give it to you for free.
So this is not an ARM or a balloon type loan. This is a lot different than that type of lending, correct?
Correct. Some people have trended towards different ARM products. They've become more popular as rates go. Well, obviously, if rates are low, people just stay away from them. You know what I mean? There's no reason to take on the risk. We have seen ARM rates that are very good. The thing is, banks again have loaded those sometimes where you have to pay points because they're not giving what's called par pricing, because they know if you go into a 5-year ARM, you're probably going to be refinancing out of that, right? So they're front loading it with more fees and different things like that. This is a 30-year fixed, so you have no risk. If you talk to me as your lender, or if you talk to any lender, you should know the full boat payment, I call it, and that's after the buy down wears out. What is your full boat payment? And that is your worst case. And if you're comfortable with that, you know exactly where it's going to go, because this isn't going to move. It's still a 30-year fixed. Your payment's just being subsidized by the seller.
So for qualification purposes, Grover, the buyer does have to qualify for the worst case scenario, right? Like that third
Right.
qualification.
Yep.
Purpose. Okay.
Yep, all paperwork is drawn up on that. Then you sign a special subsidy agreement that shows you what's going into the escrow account, shows you what your payment will be year 1, year 2, year 3, and then throughout the loan. So they do have to qualify for the entire payment. And again, I think, of course, that's good to know, because that's your worst case doomsday, scenarios that you do end up in the full payment. It's just that you're never the truth is you're probably never going to see it. Just as inflation comes down, mortgage rates comes down. It's not like like a weird prediction or anything. That's how the market works. So as you start to hear inflation come down, you're going to see the bottom fall out on these mortgage rates.
As a buyer, I can use this with any type of loan, conventional, FHA. If I'm a VA, can I use this with any type of loan?
Yeah, so it is able to be used with any type of loan. If you get into the FHA, VA and stuff like that, the seller has to pick up the whole thing. If you're in conventional as a buyer, I've had buyers pick up, a very small percentage of it, because maybe we don't get just quite enough. But FHA, VA, you got to make sure you have enough from the seller to do it. But again, it's a super attractive option. You know what I mean? And a lot of sellers are willing to do it. I've even seen people talk about doing like bidding over by 10 grand and putting in an appraisal gap, because they want that buy down from the seller. Because again, that's what's going to affect your monthly payment the most. That's where you're going to get the most bang for your buck as far as affordability.
I'm really glad that you mentioned that, Grover, too, because I did want to ask you about that. This looks like a fantastic product for our buyers, right? But what about our sellers? And, we did have a listing coming soon today. And so to speak on the sell side of things, how can we chat with sellers about why this particular option is also good for them, can be, valuable in their situation?
So it goes back to like meeting in the middle, right? And so I am seeing more and more where the seller says, okay, you asked for 10K. I'll if you increase the purchase price 5K, I'll meet you in the middle. We'll split it. But that's a side note. As a seller, as some stuff sat on the market in the second half of last year and the market kind of came to a little bit more of a halt, doing a buy down is a much more attractive option. Even the most expensive ones I see, like $700,000 loans, are around like $14,000 to $16,000, right? So you could go to a seller and say, hey, your place is sitting on the market. Let's do a $20,000 price reduction. Well, a $20,000 price reduction to a prospective buyer is only going to save them about $120 a month. Whereas, like I said, you can see these subsidies, saving them $500, $600, $700, $800 a month. So it makes it more attractive to them, while you should be able to net a little bit more than doing a full price reduction. It opens up more opportunity for more buyers to take a look, and it should be a win-win on both sides.
And we do know too that with every price reduction, we do lose a percentage of buyers looking at that listing too. So it definitely is another option that we can present to our sellers as far as, staying in the game in this market.
No, and I think it's something you don't lead with, because like I said, things are starting to thaw out a little bit. But I do think it's something that talking to the seller initially, so that they understand this is a strategy that we're going to shift to if we are stagnant or not getting what we want. It should end up being a win-win for both sides, and it just makes your place way more attractive to more buyers, and that's what you're looking for. All you need is 2 to have a bidding war. You know what I mean? It's not like you need 10. 2 people can go back and forth. So it should open more avenues for you.
Right. Absolutely.
This is great information, Grover. I actually just spoke with a buyer today. She was like, I'm on the fence about buying right now. I want to wait till rates come down. But this scenario right here gets us in while buyers are sitting on the fence and trying to wait on rates to come down. So this is a great time to buy. It's not as competitive. So getting in with this rate buy down before the rates come down like they're expected to do, and then going ahead and refinancing before that third year or before that final rate comes through is a great opportunity.
Yeah, no, I mean, like you said it best. Most people are thinking that, like, I'm going to wait for the rates to come down. I'm going to wait for the rates to come up. Well, that pent up demand is going to show up because we still have a huge inventory problem in the market, right? There's just not enough houses. So if the rates come down and that pent up demand comes, then you're going to not be able to inspect homes again. Then you're going to have to bid over again. Then the seller is going to have full control because you're up against so many people. Whereas now you're able to inspect, you're able to talk about stuff like buy downs, you're able to negotiate, you're able to take your time and look at the property and make sure it's in good shape and all that stuff. We haven't seen a buyer's window like this in Colorado in quite a while. And it's going to be just like it felt like the faucet turned off around last May or June. It's going to be overnight rapid fire. And my prediction will be about March to May, where it just kind of takes off, because that's when you're going to really hear the rates start screaming down. You know what I mean? And then people are going to come out of the woodwork. And that's the hot buying season anyway. So it looks to me like it could be a perfect storm this year. I think the biggest thing is the overall theme that we're talking about, not trying to time the market, right? I think you should, if you're looking to buy a home, it should be, what can you afford? What are you comfortable affording? And what does that get you? It may not be your dream home right off the bat, but I've been pulling market reports for listings of agents that come on the market. And we've been seeing an average of around predicted about 20 to 25% increase in equity, in price value going up over the next 5 years. That's been average in the Denver metro on the zip codes we've pulled for people on their new listings. And so if you really think about that, at some point you're going to be priced out. So if you're not in the game, get in the game and let it carry you up to where you want to be. You know what I mean? Let's match what you have down with what you can afford monthly and make it work.
So there's so much happening in the news right now, and people are scared. People are talking to, their parents or their aunts and uncles, just neighbors, whomever. And they do also say, we're going to buy when the rates come down, but then we're going to buy when prices go down. And, that's obviously not happening. Can you speak to the value in properties over the these past several years? They only continue to increase. So like you mentioned, right, if you get in now, right, you're already going to be building equity.
And even in this lull, we're not seeing a ton of like low ball offers win. You know what I mean? We're seeing at least list price, but they are adding stuff like these concessions and stuff like that. And then I'm seeing appraisals come in slightly higher, a few $1,000s higher, which shows the market is still very stable from a pricing standpoint. I don't see prices sliding backwards in any way, because again, if you looked at it on paper and took the rates and the halts out of it, we're still in a seller's market because of how much inventory is actually available versus buyers who are active. There's just not enough homes out there. And so when it turns again, it's going to be very quick. And then we're going to see those big increases, around 4 or 5% a year minimum. And it's just going to keep going from there.
Right.
Good info, Grover.
That was
and
fantastic.
How do people get a hold of you, Grover, if they want to talk to you about lending and try to get pre-qualified?
I'd love to help. I am different than most people. My direct personal cell phone, I think, is the best way. You can call or text me there anytime. That number is 303-809-5883. And if you call and I don't answer, leave a message. I'll get right back to you.
Awesome, Grover.
Yes.
We appreciate your time, Grover. Like we said, the best of the best, Grover Greer.
Get back at you guys.
We appreciate it.
And that's all on the Chris and Melissa Lombardo podcast. As always, we appreciate you joining in with us. If you have a real estate question or you have a topic that you'd like to listen to in a future episode of ours, drop us a line below, or we're always available on chrisandmelissalombardo.com. Thanks for joining in. We will talk to you soon.